a portfolio manager for Mason Stevens. For more than 20 years, he's been involved in institutional financial markets and investment management, focusing on debt and fixed interest. He's got a strong track record in analysing, formulating, developing investment ideas with a focus on fixed income management. Today, the webinar is going to focus on incorporating bonds and direct fixed interest into investors' portfolios through SMAs and some of the differences between taking the direct path that managed accounts make possible and the use of bonds, which has been the more traditional vehicle. So Alwyn, it's over to you. Thanks very much.
Thanks, Toby. As Toby mentioned, and thank you to IMAP for inviting Mason Stevens to present about and talk about fixed income separately managed accounts. We think that separately managed accounts, especially in the fixed income asset class, is quite important for advisors, and we believe that advisors can draw benefits for their clients by using separately managed accounts in this asset class. If we move to slide 3, today's webinar, we're going to talk about, as I mentioned before, fixed income separately managed accounts. We wanted to first sort of just brush on the concept around having a fixed income security and investing in a fixed income security, how that has certain attributes which clients and advisors draw on in terms of investing in and being part of a balanced portfolio. And then we talk about why investing in a fixed income fund might not necessarily draw out those benefits if you were to invest in a fund versus directly investing in fixed income securities. Next part of the presentation, we're going to talk about what fixed income means to an investor, and more. We're going to touch on the points around the investment life cycle, especially around pre-retirement and retirement, and how objectives tend to change as you move through that investment life cycle, and how financial objectives tend to dominate once you start reaching that retirement phase. And then we sort of talk about fixed income and what fixed income means to an advisor, and essentially what I'm trying to flush out is that a lot of fixed income providers tend to draw a line in the sand in terms of the way they position themselves in terms of servicing or fixed income to the advisor community, but that might not necessarily align themselves to what advisors see what actually fixed income is to them and to their clients. And finally, we want to introduce what a fixed income separately managed account is. Mason Stevens recently launched back in March a retail eligible fixed income retail SMA. We believe this is the first to market, and we feel that this is a really strong investment service that advisors can use for their clients in terms of meeting different investment and financial objectives for their clients. If we move to slide 4, for the audience's benefit, just a bit of an introduction to Mason Stevens. Mason Stevens was founded in 2010. It founded itself as a diversified financial services firm that basically supported managed account services, both on the administration side of things as well as on the investment side. We do run an investment management team or an asset management business, and we primarily focus on fixed income. We have around about $600 million of FUM with seven professionals in the investment team, 3 portfolio managers, 3 investment analysts, and 1 execution trader. And we run where we pride ourselves in the asset management business is that we run a very broad range of fixed income investment services. We have a credit fund that has very strong track record, as well as providing fixed income separately managed accounts. And for our wholesale sophisticated clients, we also run IMA or individually managed account structures for those clients. If we move to the next slide, the slide is basically titled Fixed Income Managed Funds, altering finite to infinite. The title's quite has a lot of meaning in the sense that around, what fixed income asset class and what attributes it provides to an investor versus what a bond fund provides to investors, and how pushing or investing in the asset class through a fund can actually transform some of those attributes and leave an investor not necessarily holding what they wanted to hold when putting that into a balanced investment portfolio. Moving to the next slide. I wanted to spend a bit of time on this slide. As I sort of mentioned previously in the introduction, bonds. If you look at a bond and you look at a plain vanilla bond, a bond has a finite maturity. You invest in a bond, and at a certain date, it redeems, and you get your capital back. And then from there, the investor decides whether he or she wants to invest in another bond, or pull it to cash, or decide how he's going to deploy that capital. He or she's going to deploy that capital. A bond also has defined cash flows, and by that, and those cash flows are defined through the coupon streams. So within the bond documentation, the bond will define whether it's a fixed coupon at a certain percentage of the face value that the investor is invested in, and basically over periods of time and defined periods of time, it will pay those cash flows to that investor. It's also a yield-focused security. So, and by that, when you invest in a bond in the primary or the secondary market, it delivers on an internal rate of return or a yield profile. And you can define a yield. It differs from another asset class like equities, in the sense that you can actually calculate that yield. You can define that yield. You can understand what that return profile is going to be over time, which makes bonds a very compelling investment option from a defensive perspective for a client. Last but not least, bonds have high levels of capital preservation. So provided a bond doesn't go through a credit event or a default event, the money that you invest, you're going to get that face value amount back when that bond redeems. And as I sort of mentioned below in that box, that's under the heading typical bond attributes, a bond is effectively immune from market fluctuations or fair value changes if you hold it to maturity. So, as I mentioned before, if a bond is a very yield-focused instrument, and as such, if you invest in a bond on day one with the expectation that the bond's going to redeem and you're going to get your capital back, essentially you're going to let that yield play itself out, and therefore you don't really care if the market's going up or down in your favour or out of your favour. So moving across to bond funds itself, I've used index bond funds as because it's just an easy example to translate a lot of what I'm trying to say here. Is that when you look at those attributes that I mentioned before about a fixed income security, when you put it into a bond fund, it actually transforms itself. So in the white paper, which IMAP will share with you after this presentation, I talk a lot about how a bond fund effectively transforms a portfolio of bond investments into an indefinite investment for a client. And by that, it basically you buy a unit in a bond fund, and effectively what you're doing is basically buying a share in that vehicle where that portfolio bonds are in, and essentially you, for want of a better word, you perpetualise that investment. So you lose that concept, you lose that benefit of that defined maturity, and an investor knowing that he or she is going to get that money back. Recently, another firm that's in the corporate bond space, the Australian Corporate Bond Company, issued an article which basically reinforces a lot of what I said in the white paper that I wrote a few months ago. And they what I deem as an indefinite investment horizon. When you put something into a bond fund or you invest in a bond fund, they coin it as a perpetual duration. What's important about what's important about perpetual duration should be considered by advisors and when considering investing in bond funds. So perpetual duration, especially in a rising interest rate environment, which we believe that we're about to enter into, as we've seen in the last couple of weeks, bond rates, bond yields, or the interest rate curve has steepened quite dramatically in the US as well as in Australia and around the globe. Is that the concept of duration and modified duration effectively is the sensitivity of interest rates or bond prices to interest rates. So if you have interest rates rising by 1% and a modified duration that has a factor of say 2, your bond prices are going to fall 2%. So why is this important? So when you talk about modified duration and when you talk about rising interest rates, if you're having in times of volatility in a fair value market where you're valuing the bond fund on a day-to-day basis based on net asset values, if you've got falling bond prices because of rising interest rates and you've got it's a material impact on the fund, you're going to have redemptions. So effectively, you're going to have the fund effectively runs itself into a double whammy effect. So rising interest rates drops the NAV value through drops in the values of those instruments. You have redemptions, and those redemptions forces a bond fund to start selling down other investments in the bond fund to basically support the redemptions unless they're running higher levels of liquidity. So if we move on to onto the next bullet point around investor behaviour, bond funds. When you look at buying an individual bond or buying a portfolio of bonds directly in the market, you're basically ring fencing yourself away from other investors' behaviour. If you buy a unit or units in a bond fund, if you're basically beholden to what other investors are doing, especially in a fund where you have a concentrated investor base. So if an investor decides that he or she wants or that institution wants to pull out of that fund, as I said before, the bond fund has to either redeem or use excess liquidity to pay back that investor that is withdrawing. That's quite important because if you're holding liquidity, you're not investing that capital. If you're not investing that capital, there's a dilution in your return profile. Secondly, investor behaviour basically can, as I said, in a rising rate environment, cause that double whammy effect whereby your portfolio managers have to pull away investments that they don't necessarily want to pull out, but they're forced to pull out to basically redeem those withdrawing investors. The last thing that I would say around index bond funds and bond funds that have large fund bases is around the potential for those funds to be have counterintuitive investment strategies. And what I mean by that is that when you've got a falling rate environment, you've got corporates out there, you've got governments out there, and we've experienced this in the Australian market over the last 6 months where the government's come out with 20-year bonds, 30-year bond maturities at fixed rates. Corporates and governments in a low rate environment want to lock in that long-term funding at very, very cheap rates. If you're an index bond fund, or you've got in a large bond fund which has excess capital, it's forced to basically invest in those investments regardless of what their duration views are or whether they like or don't like that particular credit or whether they want to position themselves in those investments. So that's what I mean by sometimes funds, especially large funds or index bond funds, can have a counterintuitive effect in terms of the way investors view or the way advisors may view fixed income, where fixed income is at the present moment in time, and how they position that exposure in a balanced portfolio for their clients. Move to the next slide. I think it's important to talk about what fixed income means to an investor. So we feel that fixed income should be effectively the anchor point for any balanced portfolio. The reason being is that it sits in the middle of the risk profile, and it's very broad in terms of what you can invest in and what's defined within the fixed income universe. So effectively, advisors, some advisors define things as conservative as term deposits within their fixed income allocation. And looking at the conservative end, you can include government debt, investment grade corporates, and senior ranked in terms of capital structure, senior secured, senior unsecured corporate bonds or other types of debt. That's on the conservative side, as well as you can consider things on the lower part of the capital structure or the more riskier sub-investment grade, unrated part of the investment risk spectrum, and fixed income. You can also invest in securities such as high yield securities, hybrid securities. Some advisors define fixed income as hybrids, or lower capital structured subordinated debt. So as I mentioned before, as you move towards hybrids, subordinated debt, high yield, you're kind of moving to that riskier growth part of your book or your investment portfolio, and that sort of trends towards shares. So having a component of high yield, hybrids and subordinated debt in your portfolio together with shares provides a diversified growth part of your balanced portfolio. When you look at the more conservative side in terms of cash, having an element of government securities, term deposits, senior ranked investment grade corporate debt is more on the defensive conservative part. And obviously having an element of fixed income in that sort of space helps boost the return profile, but still maintain that conservative risk element within that portfolio. And that's the reason why we sort of mentioned that fixed income should be a starting point in terms of when you're deriving a balanced portfolio. How you move, you build up your fixed income portfolio, and then you decide what elements need to support that in terms of extra risk through shares, and obviously a higher return probability, as well as bedding down through the conservative side through cash. Moving on to the next slide, we're on slide 11 at the moment. As I sort of mentioned before, I think it's quite important to think about how you position fixed income in terms of for your clients during the different phases of the investment life cycle or the life stage investment cycle. I took a lot of this information from the MySuper ASIC website. And essentially, as you can see, moving from left to right, as you go through the accumulation phase, the pre-retirement phase, the retirement phase, you start increasing your fixed income component, or they suggest that you start increasing your fixed income exposure, because what you're trying to do in your accumulation phase is basically try and build growth within in your capital base, keep building your growth in capital base till you get to the point where you have sufficient capital to derive an income from. And as you move through pre-retirement, you want to sort of bring back some of that risk and then start thinking about what sort of capital base you have and what sort of, as I mentioned before, what sort of income you can derive from that capital base without eating into your capital too much. And then once you hit retirement, you then start thinking about what sort of mechanisms you can use in terms of how you actually draw income and how you can predict that income, and then how you can then basically manage your day-to-day expenses, because you're no longer drawing a salary, obviously, when you're retired. So while I'm talking today about fixed income SMAs, we still think that bond funds actually have a place in a lifestyle, in an investor's investment life cycle. We feel that having exposure to fixed income through a fund where income and financial objectives are not necessarily your primary objective and growth is your primary objective, having exposure through a bond fund in the accumulation phase is probably a good idea, because you don't want that income, you want that reinvestment flowing through and that growth aspects within that asset class feeding through within that phase. Once you start going to pre-retirement, you start thinking about, well, how do I start drawing an income and start planning for that? And there should be a kind of a mix between having a direct bond portfolio, which is has, as I mentioned, high levels of capital preservation, defined cash flows, as well as having exposure to a bond fund to help support that growth within that asset class. But once you hit retirement, obviously, again, as I mentioned before, your financial objectives start usurping your investment objectives, and you start really thinking about, well, here's my capital base. What sort of income can I get from my investments? And that's why a lot of advisors start moving the capital or shifting the asset allocation into cash and TDs and fixed income, because they want to draw high levels of income to support their clients' day-to-day needs. Where we think a fixed income SMA works really, really well is that if you own a portfolio of bonds where you have a beneficial ownership within those bonds, you get that defined income stream coming through, and that defined income stream supports the term deposits that you have, the interest that you're earning on your term deposits, and as such, you build that income flow or income stream that the client needs for he or she to support their day-to-day spending requirements or expenses. And the next slide, slide 12, basically reinforces that idea, that reinforces those concepts that I'm trying to flesh out here. So during the accumulation phase, it's all about capital, it's all about growing capital, and probably indirect in fixed income through funds is probably the right thing to basically position your fixed income asset class exposure to. Pre-retirement phase, you're transitioning from growth to capital preservation, and therefore you're starting to move into more conservative investments, and having exposure to direct fixed income versus indirect, a mix of the two, I feel is quite important. And then finally, when you're reaching retirement phase, you want to have income generative assets, and you want to maintain that capital preservation, and that's where you shift more into having a higher allocation to something like a direct fixed income portfolio. If we move on to the next slide, slide 13, I'll move quickly through this slide. What I'm trying to flesh out, there's a lot of misnomers within the fixed income market because it is an over-the-counter market. It is a very institutional market, and by over-the-counter, there's sell-side desks that basically price bonds, and there's investors which I'm a part of, that goes to these sell-side brokers or sell-side desks and asks for prices, and therefore it's very much a one-to-one relationship rather than a listed exchange where you have a centralised exchange and every investor can go in, provided they have a HIN or CHESS account, and go and see what the prices are for certain securities in the market. But one of the misnomers is that because you've got price visibility in the listed space, doesn't always equate to liquidity. So if you look in the hybrid space, for instance, in an event where there's a sell-off, if you take January or February this year where there was, a lot of the bid side goes away in terms of and therefore in terms of volume, and sometimes the market can't support it. There's a price there as a bid offer that's listed on the exchange, but price visibility doesn't necessarily equate to liquidity. The bond universe, a lot of people think that it's a lot smaller than it actually is, because the listed bond space is quite small. If you look at listed bonds in the ASX, it's in the realm of around about $8 billion. If you include hybrids, which is circa about I think $38 billion, the total market's only about $46 billion in the corporate financial space. When you add in, we actually look at the OTC market. The OTC market's about a $1.5 trillion bond market, and if you have a bond fund that invests purely in the listed space, we feel that it's not representative of what you can get in the OTC market space. A lot of people and a lot of advisors, and this is not us drawing a line in the sand, by the way, but a lot of advisors consider hybrids because of access through the exchange, and because some of the attributes that hybrids have, that they actually classify hybrids as fixed income. Hybrids are actually a preferred equity instrument, and it more trends towards equities and shares than it does towards debt. The reason being is that the coupons or the dividends that they pay, which they actually are dividends and not coupons, are non-cumulative. So in an event where someone decides, or the issuer decides not to pay a coupon or a dividend, they don't aggregate to the next dividend or coupon. And also hybrids convert to shares on the mandatory conversion date, and without the mandatory conversion date, they're actually considered a perpetual instrument. While we don't think this will happen in the Australian market, we've seen some instances in the COCO market or offshore global hybrid market more recently, such as Standard Chartered not calling their COCO security, and now it's basically in a perpetual phase at the moment, and no one knows when it's going to get called. So there are those risks associated with hybrids. Access. I think there's always a question around fixed income being an institutional market. This is provided you have the right setup in terms of having a managed account provider or broker that has a custody capacity in the fixed income space. Anyone can access fixed income, and fixed income can be invested in anywhere from $1,000 lots to the Austraclear clearinghouse minimum, which is $500,000. Having that custody capability or custody support basically allows an investor to basically build quite a diverse portfolio of bonds, even at a minimum portfolio size of $50,000 to $100,000. There's also a misnomer around fixed income being a very complex and therefore very risky asset class. It's only complex in the sense that it has defined attributes. And those defined attributes, while they may seem complex in terms of a valuation perspective, actually gives an investor more certainty. And that's the reason why it is classified as a defensive asset class. If we go to the next slide, I just wanted to, as I sort of mentioned earlier, what fixed income means to an advisor. As you can see in slide 15, I highlight what a corporate capital structure is and a financial institution capital structure. Essentially, the capital structures are basically, your first loss piece or the loss that that investors take is in the equity piece. And they're your ordinary shares that investors hold through the ASX listed exchange or unlisted shares that they hold, and they're the most risky. That's the most risky part of the capital structure. But advisors can, when we've sat in front of advisors and they're now experienced advisors, they can classify anything from hybrid to covered bonds in the financial institution space, and from hybrid convertibles to senior secured debt in the corporate space as fixed income. And and I think providers of investment services such as Mason Stevens need to adapt and align themselves to advisors such that hybrids does have an exposure within, if advisors do classify hybrids as fixed income, that those investment service providers within fixed income do provide and adapt and align themselves and provide an exposure to hybrids such that advisors' clients do get exposures right up and down the capital structure of both a corporate and financial institution. I just quickly wanted to go through what type of bonds there are in the markets. There are fixed rate bonds, and fixed rate bonds have a defined maturity date as well as paying a fixed percentage coupon. These bonds basically, for example, if you've got a 5-year bond that pays a 5% coupon on a semi-annual rate, every 6 months you get a 2.5% annualised coupon, basically hitting your account, or should hit your account if you have a beneficial ownership in that bond. A floating rate note basically neutralises duration in the interest rate duration, and effectively you basically you move away from having exposure into interest rates, because essentially what a floating rate note does, it basically plays a floating rate coupon that's linked to a floating rate such as a bank bill swap rate or BBSW. You can invest in inflation-linked securities either through a capital index bond or index annuity bond. And these are quite important securities in terms of an investment portfolio because essentially gives you an inflation immunisation through that portfolio, and which is quite important in the sense of, especially now, where the markets or economists are talking about inflation becoming hitting our shores through Trump winning and Trump being a very expansionary type president and wanting to spend. Inflation could be in the headlines and probably remain in the headlines over the next 6, 12, 18, 24 months. Finally, fixed income also encompasses asset-backed securities, and these include things such as residential mortgage-backed securities. And some people, some investors want exposure to real estate. You can either do that through REITs or owning property directly. You can also get that exposure through investing in asset-backed securities, and you can define the risk that you want to invest in anywhere from, because asset-backed securities are issued different tranches, anywhere from very secure, senior secured tranches right down to first lost equity tranches. So there's a good that's a good way of basically risk profiling your property profile or your property investments if you want to get access to the property file without going directly into that space. Now I sort of wanted to introduce you to fixed income separately managed accounts. How do separately managed accounts evolve or come about? I think they became quite popular post GFC, where equity funds, a lot of equity funds saw a lot of redemptions, a lot of bond funds saw a lot of redemptions through the GFC, and there was a lot of funds that started freezing themselves in terms of redemptions, and investors and advisors basically determined at that point in time that, one, they didn't want to be beholden to managers and other investor behaviours that you experience through funds, but they also demanded increased transparency. So separately managed accounts over the last 6 to 8 years have grown in popularity, especially in the equity space. In the fixed income space, it's been a little bit more slower in terms of taking traction. But in my view, separately managed accounts where you actually hold and have a beneficial ownership of the securities that you invest in, from the fixed income attributes that I mentioned earlier in this presentation, I think they're probably more important to basically have a separately managed account in the fixed income asset class than I think that I believe having exposure in equities in a separately managed account, and the reason being is that because you hold those securities on a beneficial basis, effectively you have the ownership rights and the benefits of those coupon streams that I mentioned before, and you have the benefits of that capital redemption that you have. What is important about separately managed accounts is that versus going to the other extreme and holding a direct portfolio of bonds, is that separately managed account overlays it with a professional management team, a team that's like myself, that's been in fixed income markets for a long number of years, have managed money before, knows how to negotiate in the OTC markets and get the best price for clients, for investors, and basically be there in front of the desk 24/7. And I think this is quite important in the sense that for advisors that do like the concept of direct investments, especially in fixed income, it frees them up to basically spend more time with their clients and understand what their clients' needs are, and then knowing and safely knowing that there's a professional investment team managing a portfolio of fixed income securities for them. If we go to slide 19, we believe that we've built the first, or offering the first retail eligible fixed income separately managed account. We only invested in the Aussie denominated space in investment grade securities, and we have a portfolio of fixed and floating rate securities which allows us to move in and out depending on market events in terms of the way we weight and our duration views and the way we weight different parts of the portfolio in terms of cash, government securities, corporate securities, financial institution investments. The retail fixed income SMA, or the Australian fixed income model portfolio mandate, typically holds around 12 investments, 12 to 15 investments. And we can go up to 20, 25, 30 investments, and we have a mandate minimum of 5 investments. We have a target return, we have a benchmark of RBA cash rate, we're absolute return, because the retail fixed income SMA is a yield-focused investment. And we have a target return of RBA cash plus 2% net of fees. The minimum investment amount is $100,000, and we suggest that because it's a yield investment, that the time frame should be around 3 to 5 years. If we go to slide 20, a lot of these client and advisor benefits I've already fleshed out in previous slides. The client has, as I mentioned before, has beneficial ownership in the portfolio of fixed income investments, and that delivers a higher return net of fees to term deposits. They gain the benefits of high levels of capital preservation, and they also have liquidity benefits compared to term deposits, where in the cash space you've got to give, now there's a requirement you need to give 30 days notice. We can tend to buy and sell within 1 to 2 business days at position. It has a defined and predictable income stream, and as we only invest in the investment grade space, it's a portfolio of quality fixed income investments, and we feel that it's because we invest in the OTC fixed income markets. It's pure fixed income. It's representative of what fixed income should be. Advisor benefits, it's a full end-to-end service which is scalable for advisors, and it's managed by a professional investment team on a centralised administration platform, and like as I said before, freeing that investment decision and removing that investment decision away from the advisor allows the advisor to spend more time building their client bases, as well as understanding their clients better in terms of their financial and investment needs. And I thought it's best to show that from a diversification perspective, where our retail SMA sits in terms of senior capital structure as well as credit rating. Finally, I just wanted to give you a summary of what a fixed income SMA provides. It's an income generator, so it's very good for retirees. Gives you beneficial ownership of the securities. We have an open architecture managed account administration service that supports this type of investment structure. It has a business alignment, as I mentioned before. And we feel it's an enhanced value proposition for an advisor and for the advisor's clients. On that note, I finished my presentation, and I'm happy to take questions. Yeah, so
You have to mark them to market.
yeah, we do. We do mark them to market, but we feel that if you're a yield-driven and income-driven investor that's holding a portfolio of bonds and invest in those portfolio bonds based on the return profile it's going to have, and allowing that portfolio bond to play itself out, I think that's quite an important thing. So when you talk about NAV changes in that terms of portfolio or fair value change in that portfolio, that just becomes noise if the investor is satisfied, he or she is satisfied with that yield profile that it's trying to deliver. So yes, when talking about SMSF and what the requirements are, yeah, we do provide the investors or the advisor to provide their investors monthly reporting around their bond portfolio, as well as they can log on online and see the movements on a daily basis.
There's a question here from James Jarvis. How does the trading of individual holdings work for an SMA, given that holdings are less than parcel size?
Yep. So there's a number of routes that I only can talk on Mason Stevens' behalf. There's a number of routes that we take. We essentially can go to the market and we can trade on an aggregate level in terms of our client demand. So the great thing about a separately managed account versus something like an individually managed account is that separately managed account, every investor has the same portfolio. So from a portfolio manager's perspective, that's a scalable solution in its own right. So if we wanted to change one of the positions within the fixed income portfolio, we can then aggregate those positions and then go to market and bid for institutional sized parcels, which tend to be greater than $500,000 because Austraclear requires you to settle through that. If we don't have sufficient parcel size, we can go to other parts of our network in terms of who is holding that bond and see what that bond means to their portfolio. And if that investor within our network wants to sell that parcel or a party of investors, that we can purchase off them internally. And then finally, we support a portfolio of bonds on our own balance sheet also that can help facilitate flow.
Well, the second part of this, which is really then how does Mason Stevens ensure best pricing and execution for a client in some of those sort of second and third options where you're trading as a principal or trading with other firm clients?
Yeah, so we will go in the market and we'll price a security based on the minimum parcel, and that's our reference point. And from that reference point, we then we apply that price to that particular parcel that we're trying to pick up. There's another thing that I should mention also is that we don't derive transaction costs through the separately managed account, and because we don't derive transaction costs, we're not trying to churn the books, or we're not trying to churn the book, or trying to derive a bid offer spread here. So we're buy-side investors on a number of different perspectives within our business, and because we're on the same side as the investor, we're just looking for the best price that we can pick up for the investor, and also supports our track record also in terms of our performance.
All right. I have a question, Alwyn, which is has to do with concentration risk. If I invest through a bond fund, I'm going to end up owning somewhere between 200 and 2,000 securities. If I own bonds directly and I've got $150,000 to invest, I'm going to end up with somewhere between 10 and 20. Am I taking on more concentration risk?
Which I think is a very good question, and we get this question a lot. The response that I have to that is that the number of securities that you have versus if you take the Aussie dollars corporate bond space, which this SMA invests in, doesn't mean that you're going to have a dispersion of issuers that are sufficiently diversified. So there is an Aussie dollar bond fund out in the market, quite a large one, quite a prominent one in the market. It has 57% of its portfolio invested in government securities. Is that diversification? Just because they hold 100, 200 securities in the government space, I wouldn't classify that as being diversified from that space. So what we try and do with the SMA, and I think this is where an investment manager proves his or her worth, or the team's worth, is the ability to basically monitor the market, pick the right securities that are basically providing the highest yield, as well as so that they can deliver on performance, the best performance for the clients, and basically be able to assess which parts of the markets to be invested in on the client's benefits, because that's what we're essentially paid to do. The second thing that I would mention around concentration risks and SMAs and funds is that we really what we're trying to do with the SMA is provide a portfolio of good performing securities that has a high level of capital preservation, as well as defined income streams for the client to meet certain objectives of that particular client. when you're looking at the corporate bond market and you're looking at the investment grade space, and you look at Standard & Poor's statistics, you look at Moody's statistics, in the investment grade space, default ratios, and this is what we're really we should concern ourselves of when you're buying a portfolio of bonds that you're looking at from a yield perspective and you're trying to hold to maturity, is something in the 20-year historical default rates are around 0.2%. So when you add on the probability, the management probability aspect around it of a professional manager trying to select those bonds, that 0.15% reduces even further in terms of the potential for that particular investment to lose money.
Alwyn, with your bond portfolio, how much does it change in the SMA over time? So an investor that goes in at the beginning of 2016 versus an investor that goes in at the end, I'm sort of presuming the portfolios shift and become quite varied. It's not like these are homogenous portfolios that are be driven by just what's available in the market at that time, and the investor portfolios could be quite varied across an advisor's client base?
No, so an SMA is one portfolio for all clients. So if we move out of a bond position and into a new position, or if there's a market event and we take it to 100% cash, for instance, every client moves to 100% cash. So every client will have the same portfolio no matter whether he or she entered in November 2016 or November 2020. That bond portfolio, I think you're referring more to IMAs, which are individually constructed portfolios, and that's when you can see a lot of changes through the client base. That's why I think an SMA is quite adaptable to advisors, because in terms of scalability, it allows that scalability to happen. In terms of the way we manage the SMA from an investment perspective, I think it's quite important from the sense that first and foremost, we look at it from a yield perspective, what we're trying to achieve from a 3 to 5 year horizon. We then look at accretive positions in terms of, does a bond opportunity, is it accretive to the portfolio or not accretive to the portfolio? It's only then that we'll consider switching in and out of that and making changes to that portfolio. Unless we have a fundamental view change around interest rates and duration, or we think there's going to be a market event and we need to be a lot more defensive in nature, we're not going to inverted commas churn the portfolio or trade the portfolio as much as a bond fund, which obviously, and the benefits of a bond fund obviously has capability around derivatives. You lose transparency, but you have derivative hedges that you can use, and you can manipulate the portfolio in a number of different ways. We want transparency.
In a market that is not as frequently traded, doesn't that mean that you're trading off investment performance for uniformity?
No, we think that the market is as highly as liquid as ASX. I think that's one of the myths that like I sort of mentioned before, statistically, from 90% of the time, we're able to get out of position within that same day, if we needed to, or we're able to get into a new position within the same day.
All right, look, thank you very much. As Alwyn mentioned, Mason Stevens have a white paper, which I think Alwyn is the author of which Alwyn is the author, and we'll be sending a copy of that out to all the participants in today's webinar. So thank you very much, Alwyn, and that ends today's presentation. Thank you.